Learning Objective 1-6. Understand additional considerations associated with business combinations. So there's a couple other things that the book goes into, and some of these will help you in future chapters, and some of them are just important questions to know. The measurement period is a pretty cool feature. It takes a while to value a company, and it takes to value a company's assets. And it can take longer than the amount of work needed to do the acquisition itself. So in other words, you may decide you're going to make the acquisition, and you go through all the work to plan the acquisition and go about doing it. And you may still not know what the value of all the assets happens to be. So what ASC 805 allows for is it allows for a period of time, which can even extend after the acquisition itself, to determine what the fair value of all the assets are. And you can actually adjust the fair value of the assets and also adjust your goodwill during that time period. So remember the chart that I gave you. If your write-ups are higher, then your goodwill is going to be lower, right? If your write-ups are higher, your FMVNIA is higher, then your goodwill will be lower and your write-ups are going to be higher. If your FMVNIA turn out to be lower, then your write-downs are going to be lower and your goodwill is going to be higher. So these are going to usually offset goodwill. It could also create a bargain purchase in some weird situation. And you have up to a year to do this. Let me give you an example. So here, the company initially determines that the land is worth $100,000, but it still has a little bit of homework to do. So later on, it determines that the land is worth $110,000. That was the value on the date of acquisition. It would record, therefore, it would increase the book value of the land by $10,000. So debit land for $10,000 and credit goodwill. It would come out of goodwill because goodwill was initially, the more the fair market value of the net identifiable assets, the less the goodwill. Then they determine there's a rezoning and the land is worth less. It's now worth $75,000 because of the rezoning. And this happened after the acquisition. The rezoning would result in an impairment, and it would not affect the initial value because the rezoning took place after the acquisition. So you would then write it down from 110 to 75, but all of this would still stand. The goodwill would still be at $10,000. And it's important to note that the revaluation as a result of the measurement period is different from a revaluation due to something like an impairment. What's most important here is what was the value of the asset on the date of acquisition, and if subsequent events happened, that's completely irrelevant. Here are some other weird things that can happen. Sometimes the consideration is based on a contingent matter, like future sales. So it might be that I'm going to pay you $1 million now, and if sales exceed a certain number next year, then I'll pay you additional $500,000. So that'd be called contingent consideration. What you need to do is you need to value that at fair value on the date of acquisition, and it could be an asset or a liability. In other words, what you would do is you would increase the purchase price and then create a liability on your books for this contingent consideration. Now, how do you value something like that? Because the reality is that it's not exactly, these things usually aren't traded on markets or anything like that. So what you would usually do is you would use an expected value. You would try to set what the probability is that this is going to be hit, and you multiply the probability of it happening by the total amount that you're likely to pay. So that results in what's called an expected value, as you probably have learned in a statistics class someplace. An inquiry contingency, the acquirer must recognize all contingencies under the same guidelines that you would always recognize contingencies. So if there's a lawsuit out there, then you need to include in your fair market value of the net identifiable assets a liability for that lawsuit if you would have to book that lawsuit if it was against you in the first place. So things like lawsuits need to be included as contingent liabilities as part of fair market value of net identifiable assets. R&D projects can be capitalized. So if there's an in-process R&D project that the acquiree is working on, and the parent is buying the company and it plans to use that has some value to the parent, the parent can capitalize it. Normally, there are normal rules for capitalizing R&D, and these do not necessarily apply in this situation. So if the company has an R&D project that the parent intends to use and they can assign it a value, then they can actually capitalize it. And of course, later on, they need to test it for impairment. Because if they're no longer using this R&D, then it's going to need to be written down. Now, an important issue is that sometimes the acquirer makes investments in steps. In other words, the acquirer might buy 10% of the stock and hold that for several years before they buy the whole company. So here they describe it as non-controlling equity. That can be a little confusing. We're not talking here about a non-controlling interest, although it is a non-controlling interest. That's not what we're saying here. What we're saying here is that the parent owns some stock and then before they bought the whole company. So what do you do with that? Because when we say consideration, the parent is buying a certain amount, paying a certain amount for the stock of the company. But what if they already own some stock? So they're not buying the whole company then because they already own some of it. So what do you do with that? And that's considered part of the consideration, and it's valued at fair market value. Let me show you how this would work. This is on page 23 of the book, so that's just someplace you can refer if you want more information. Okay, the acquirer held 10%. Potter is buying, and Snape is the acquired company. Potter held 10% of the stock already, and now it's buying the rest. It's buying the other 90% for $4,500,000. And this stock, this 10% of stock that Potter already held, was on the books for $300,000, and on the date of acquisition, it's worth $500,000. That would make sense, right? Because let's say there's 100 shares, 90 shares of $4,500, so 10 shares are worth $500. What Potter would do is it would write up this investment to fair market value on the date of acquisition. So you debit investment in Snipe Company stock for $200,000, and you'd credit gain on revaluation of Snipe Company stock, $200,000. And then for the rest of the acquisition, it would just be debit investment in Snipe Company stock for whatever they're paying here. They're paying $4,500. Credit cash, $4,500. And that's how that would be recorded. Sorry, that was Snape, not Snipe. And I'm not such a Harry Potter person. I've seen some of the movies, never read the books. I don't know. I think I read one of the books once. My kids would kill me if they heard I just called Snape, Snap, whatever. Parent creates a gains control. All right, so let's just go over a little bit of the concept here of the idea of control. One more thing. Control is not just about 50% plus, but it can also be a situation where you hold other companies that hold 50%. So you could have, well, first of all, here's examples. If you own 80% or more than 50%, you're going to consolidate. If you own less than 50% but more than 20%, we're going to get into this in more detail. It's not just that. You're going to use something called the equity method. If you control this through several other subsidiaries, we'll get into this in a future chapter, then you're also going to consolidate. So anytime that the parent has control over the sub is when you would consolidate. And the FASB has never been clear about this rule. It's never quite been able to get its arms around exactly how it works, but it's tried really hard. I'll give him credit for that. So if you have two or more entities that are under the same control, any entity where you have this control, then you're going to do something called consolidation. And consolidation means that you take the two sets of books and you combine them as if they're one set of books. So let's take an example here. And I apologize because these PowerPoints, it could be a little clearer. Let's say we have the parent and the sub. And the parent owns the sub. So we have a balance sheet here for the parent and a balance sheet for the sub, and it's a very small sub. Then the consolidated should be the two combined. So you have $300,000 in cash, $1,500 in PP&E, $500 in liabilities. The equity is all of the equity of the parent, because the equity of the sub belongs to the parent, right? The only real stockholders are the stockholders of the parent. The stockholder of the sub is the parent itself. So the only equity here that really exists is the parent's equity, which is owned by external stockholders. The sub's equity is the parent. So therefore, this is what your balance sheet would look like. And you would do something called elimination entries in order to record this. And they added something to this which makes it a little confusing. There's also here a receivable from sub and a payable to parent. In other words, let's add one more thing to the problem before we do this. And that's that the sub owes the parent $100. So the parent has a receivable from the sub of $100, and the sub has a payable to the parent of $100. The two things that you would need to do to consolidate is you would need to eliminate this investment in the sub against the equity of the parent, because this equity is really on the parent's book, the investment. So what you're going to do is to add this across in a spreadsheet. You would debit equity and you would credit the investment, because this investment's a debit, so crediting it brings it to zero. This equity is a credit, so debiting it would also eliminate it. And then all you would have left is this $1,500 in equity here. Would now make it all the way to the final consolidated balance sheet. And that's what this is here. This is your consolidated balance sheet. There's one more elimination, and that would be this receivable versus the payable. The sub owes the parent is owed to by the sub. And if you combine this together, you're going to show a balance sheet with a receivable and a payable to the same company, because this is really one company. So this needs to be offset against each other and removed. I'll make it another color here, green. So I'm going to do is I'm going to credit the receivable and I'm going to debit the payable. And what this gives us is, again, a consolidated balance sheet where we just have $300 in cash, $1,400 in PP&E, $400 in liabilities, and $1,300 in equity, which is what's really going on. So that is chapter 1, in a lot more detail than I've done in the past. I hope that it's helpful to you and that it's not too much information. The next thing to do is, if you want, go through the book again, make sure that I got everything, make sure that you got everything, really. And then if you want, what you can do is I've set up practice problems in Connect. And these are optional if you just want to try some things out. What I've done is I've selected problems that if you go through this sequence, you'll get a very good review of the chapter that should get you ready to do the assignments. It's optional. And I don't look to see if you did it or not. I think I have data available, honestly, but I have better things to do to see if you looked at it. I care about how you do. I don't want you to think that I'm looking over your shoulder whether you're doing it or not. What you do want to do, and what I do care about, is that you do the assignment. So there's going to be an assignment. The assignment's usually longer, and it's graded based on how much you get right, and with all the bells and whistles that connect. Again, the practice is good practice so that you're ready to do the assignment. But some students feel like they're ready to jump right into the assignment. If you do, that's great. So go ahead and do the assignment, and then there's also a chapter quiz which you need to complete. And that's everything for chapter 1. So thank you for watching the videos, and I'll see you for chapter 2.